Imagine possessing a bank vault that is universally recognized, heavily guarded, and certified by the world's leading financial watchdogs, only to open the heavy steel door and find nothing but dust. In June 2020, the global financial system peered into the vault of Europe's most celebrated technology company and discovered exactly that. Exactly 1.9 billion euros simply did not exist. It was a staggering evaporation of wealth that shattered the illusion of a European economic miracle and exposed a labyrinth of corporate malfeasance. This was Wirecard, a digital payments behemoth that had positioned itself as the undisputed future of global commerce. At its absolute peak, the company commanded a market valuation exceeding 24 billion euros, eclipsing traditional, centuries-old banking titans. It secured a coveted spot on the DAX 30 index, Germany's benchmark of elite blue-chip corporations. The giant promised frictionless transactions for a rapidly digitizing world, seamlessly processing payments for international airlines, global retailers, and countless online merchants. But behind the polished corporate veneer lay an intricate architecture of deception. How does a publicly traded entity orchestrate a phantom business of this magnitude under the relentless forensic gaze of modern financial scrutiny? The answer lies not merely in fabricated ledgers, but in a profound systemic failure where the desperate desire to believe in a homegrown technological champion deliberately blinded those tasked with protecting the integrity of the market. The genesis of this monumental collapse traces back to the early 2000s and the arrival of Markus Braun, an Austrian management consultant with a penchant for black turtlenecks and grand techno-utopian visions. Braun took the helm of a struggling internet payments processor. The company had barely survived the dot-com crash by servicing the murky, high-risk underbelly of the early internet, primarily processing credit card payments for online gambling syndicates and adult entertainment websites. Braun recognized that to achieve astronomical growth and secure institutional capital, the firm needed to aggressively shed its unsavory origins. He rebranded the operation as a cutting-edge financial technology firm, or Fintech, blending the disruptive agility of a Silicon Valley startup with the regulatory weight of a licensed German bank. This carefully constructed dual identity became the ultimate camouflage, allowing the company to project an aura of unassailable innovation while operating in the shadows. To execute this aggressive global expansion, Braun relied heavily on his ambitious and deeply enigmatic Chief Operating Officer John Marsalek. Together, they constructed the central mechanism of the fraud, built around a legitimate industry concept known as third-party acquiring. In international regions where the German company lacked the necessary regulatory licenses to process payments directly, they claimed to partner with local licensed entities to handle the complex transactions on their behalf. The anatomy of this sophisticated scheme relied on profound geographic and corporate opacity. These third-party partners were purportedly processing billions of euros in transactions for countless merchants across Asia and the Middle East. The German parent company would then record a lucrative, high-margin commission for referring these merchants to the local partners. On paper, it was a frictionless, brilliant revenue stream that propelled the firm's stock price to dizzying heights and silenced early critics. In reality, the vast majority of these Asian partners were little more than empty corporate shells. They operated out of obscure, unverified addresses, sometimes sharing modest office space with retired individuals or functioning as entirely empty rooms in Manila and Dubai. The staggering volume of digital transactions they supposedly processed was entirely fabricated, a digital ghost ship sailing uninterrupted through the global financial system, generating phantom revenue to meet Wall Street's relentless expectations. To legitimize these phantom profits and integrate them into the official balance sheet, the architects of the fraud utilized escrow accounts. In finance, an escrow account is a specialized holding tank managed by a trusted third party to secure funds until a transaction is finalized. The company claimed that the massive profits generated by the Asian partners were being held in these escrow accounts in the Philippines and Singapore, safely accumulating interest while waiting to be repatriated to the corporate headquarters in Munich. This is where the illusion required complicit or profoundly negligent institutional enablers. For over a decade, the prestigious global accounting firm EY served as the company's auditors, tasked with verifying the financial health and operational reality of the enterprise. Year after year, these auditors signed off on the balance sheets, effectively placing a golden seal of approval on a hollow, decaying structure. They were fooled by forged bank statements, circular transactions, and a toxic corporate culture that aggressively stonewalled any rigorous inquiry. The auditors failed to perform the most fundamental duty of forensic accounting, which is directly verifying the existence of the cash with the banks purportedly holding the escrow accounts. Instead of demanding independent confirmation from the Philippine banks, they relied on documents provided by the company itself or by deeply compromised local trustees paid by the very executives they were supposed to be auditing. It was a catastrophic lapse in professional skepticism, allowing a localized deception to metastasize into a global systemic threat. The regulatory environment provided a similarly fertile ground for the deception to flourish unchecked. Germany's primary financial watchdog, BaFin, was fiercely protective of the nation's sole digital champion. When international journalists and aggressive short sellers began raising alarms about glaring irregularities in the Asian operations, the regulators did not descend upon the corporate headquarters to seize hard drives or interrogate executives. Instead, BaFin turned its formidable state powers against the critics. In a chilling and unprecedented move, regulators filed criminal complaints against the financial journalists attempting to expose the truth and temporarily banned investors from betting against the company's stock. This defensive posture sent a clear, dangerous message to the broader market. The German financial establishment would shield its prized asset at all costs, effectively weaponizing regulatory authority to protect what was rapidly becoming a criminal enterprise. The protective regulatory shield could not permanently withstand the relentless pressure of independent investigative journalism. The Financial Times published a series of meticulously documented exposés, utilizing leaked internal emails and brave whistleblower testimonies to systematically dismantle the facade of the third-party acquiring business. The reports detailed exactly how executives in Dublin and Dubai were actively conspiring to forge contracts, backdate agreements, and artificially inflate sales figures to deceive the market. The pressure reached an absolute critical mass in the spring of 2020. Under intense public and institutional scrutiny, a special independent audit conducted by KPMG failed to verify the existence of the Asian profits, citing a total lack of original documentation. As detailed in the devastating KPMG Special Audit Report, the investigating accountants encountered unprecedented obstacles, missing data, and continuous delays from the company's highest executives. The house of cards finally collapsed in June 2020 when the Philippine banks, where the 1.9 billion euros were supposedly held in escrow, categorically stated that the German payment processor was not a client. The banking officials confirmed that the documents presenting the massive cash balances were crude, amateurish forgeries. The money was not missing. It had never existed in the first place. The implosion was absolute and immediate. Within days, the company filed for insolvency, wiping out billions of euros in shareholder value in a matter of hours. Retail investors who had blindly trusted the DAX 30 inclusion, massive pension funds that had relied on the audited statements, and thousands of employees who genuinely believed in the technological vision were left holding worthless equity. The human cost of the deception rippled outward, destroying lifelong savings and fundamentally shattering international faith in the European capital markets. The primary architects of the fraud faced wildly divergent fates in the chaotic aftermath. Markus Braun was swiftly arrested, stripped of his billionaire status, and thrust into the center of a sprawling, multi-year criminal trial. From the defendant's bench, he vehemently denied any knowledge of the systemic forgery, attempting to cast himself as the tragic victim of a shadow operation orchestrated by his subordinates behind his back. Meanwhile, Jan Marsalek executed a brazen and meticulously planned escape. Evading a coordinated global manhunt, the former chief operating officer vanished into the geopolitical shadows. Authorities alleged he utilized complex networks of private jets, forged passports, and deep pre-existing connections to international intelligence agencies to flee across borders. His disappearance added a chilling layer of state-sponsored espionage to an already unprecedented financial crime, leaving investigators grasping at shadows. The ashes of the Wirecard scandal continue to smolder, serving as a dark, permanent monument to the severe vulnerabilities of modern finance. The disaster forced a painful, industry-wide reckoning within the auditing profession, prompting fierce legislative debates about the inherent conflicts of interest when massive corporations pay the very accounting firms tasked with policing their integrity. It exposed the fatal flaw of national pride in regulatory oversight, demonstrating how the desperate desire to foster domestic innovation can fatally compromise the absolute mandate to protect the public. The anatomy of this fraud reveals a terrifying truth about the modern digital economy. As financial transactions become increasingly abstract, represented by mere lines of code crossing invisible, frictionless borders, the operational space for deception expands exponentially. The mirage sustained itself not merely through the criminal brilliance of its architects, but through the willful, collective blindness of an entire financial ecosystem desperate to believe in the intoxicating illusion of limitless, uninterrupted growth. The 1.9 billion euros were never truly lost because they were never earned. They were a phantom currency minted from pure ambition, sustained by profound systemic negligence, and ultimately paid for by the devastating reality of those left standing in the wake of the collapse. When a company fakes its own reality on such a massive scale, it does not just steal money. It steals the fundamental trust upon which the entire global financial system relies.